As trade and economic uncertainty weighs on Wall Street, European markets have been enjoying somewhat of a resurgence. Here to tell us more about what's going on in that market is Michael Brown, Vice President, Director, and Portfolio Manager with TD Asset Management. Michael, always great to catch up with you. What is driving this outperformance of European equities?
Well, first, thanks for having me, Greg. It's happy to be back. Looking at year-to-date performance, we've got Europe up almost 14 to 15 double-digit performance versus a U.S. which has languished year-to-date. This is, of course, following multiple years of U.S. outperformance relative to Europe. But there is some positivity. Instead, I wouldn't really say there's been an economic growth resurgence in Europe as much as some steady state positive news as opposed to negative news in terms of relative to the U.S. So there's been a few things that have happened. First, there has been the stimulus and then a very productive election with in Germany, where they're now talking about increasing it actually passed today, 500 billion euro stimulus plan, which is very positive, of course, for equities. At the same time, Europe has traded for a number of years at a valuation discount to the U.S., so that has also contributed as there's been a more normalization in terms of Europe typically would trade at a discount because of its lower growth, but the gap got to pretty extreme levels going into the end of last year. So there's been some catch up there. And really what we've seen here with some of the changes that has happened to our neighbors south of the border, we've seen a more cohesive Europe working together, thinking of actually some stimulus plans and working together to increase the growth in Europe, which is all quite positive. In terms of barring complete decoupling is probably not likely. The U.S. economy will have an impact on Europe regardless. But what we're seeing now is some positive changes, and it will eventually all come down to earnings in specific companies. And as that growth continues and they deliver, then we can expect some nice performance out of Europe.
We can show the audience a chart of what we're talking about in terms of the rise in European markets. As I take a look at this, it starts going up and to the right. You're talking about the U.S. outlook deteriorating. Does this mean that we might see a prolonged upward trend in Europe based off this, the short-term chart we're looking at right now?
I think there is definitely some positives, like I said, about the German stimulus measures. There's also the working together in terms of Europe as a unit. Is positive. The newly German elected parliament is actually actively positively removing some of the historical debt breaks that they have, so ability to stimulate the economy. You're seeing political unity in France, which was a high degree of uncertainty coming into the end of last year. That also seems to be quite positive. And then above all, it really is the spending and just a positive environment for growth. Or more positive. It is still Europe, so we're talking low single-digit growth, but it is positive. So.
More positive than it's been for a while. You talked about specific things that are happening, country specifics, changes in Germany and France. If we start stacking their markets up against each other, Germany maybe versus France versus the UK, what kind of story are we looking at?
So the UK is a separate entity with post-Brexit. It definitely moves more independently. We would typically look at the companies within Europe as a whole, and then we would look more as a risk overlay to make sure we're not overexposed to France, overexposed to Germany, and then being cognizant of the countries with independent exchange rates, obviously the largest being UK, but also Switzerland with a Swiss franc. And then Norway also has an independently moving currency as well. But it is really a focus on the individual companies. It's very rare that you would be looking at a company that only does business in France or only does business in Germany. So.
That's interesting. I hadn't thought about the fact that obviously with that geography, companies would be working, in several countries at once. Well, we know that the European story has been a lot because of policy changes we've seen in Washington, having to focus on increasing their defense spending. You were talking about Germany, infrastructure spending. If we start to look at that through an investment lens, do we start thinking about opportunities in terms of sectors?
Mm-hmm. The biggest move year to date has come out of the aerospace and defense sector. So what you've seen here is increased spending. They're talking €1 trillion over the next 10 years into defense spending, which is largely going to some of the European suppliers, whether they've been Rheinmetall, Leonardo in Italy or BAE Systems in the UK. They've been huge beneficiaries of this. I mean, this is almost 40% year to date in terms of aerospace and defense. And it was a relatively strong, I mean, since back when I guess Trump 1.0, where he talked about increasing budgets for defense, that has been happening over time. But really what we've seen now has been a significant acceleration in this defense spending. And these have been significant beneficiaries.
For a Canadian audience, or sorry, for a Canadian audience listening to this, what would we do about these opportunities? I think you're going to talk about infrastructure as well.
Yes. So the couple areas that in terms of Europe that are positive, infrastructure spending, they do have significant industrials as well as utilities, which would be beneficiaries of some of the infrastructure rollout. That's also been positive. Another area that's actually been doing very well in Europe has been the financial sector. I mean, it's not up 40% year to date, but it is up 20% year to date. These, the banks have been performing. This really has been going on for a number of years, where there has been an inflection. They had negative interest rates for a very long time. And then post-COVID, with the rate increases, the return to profitability has been quite strong. And what we're seeing here as well, like with an extension of this profitability, is more potential for like rates. They are cutting rates to stimulate growth, but not a return to negative rates, which is positive for banks, and they've been able to adjust their profitability. Also within Europe, the insurance, there's many global leading insurance companies within Europe, which are looking at, some even have ADRs that trade locally. And but this has been a bastion, like whether it be Munich Re, Swiss Re, so the large reinsurance names, the two largest outside of Omaha, as well as Zurich, which owns pharma, or like high quality financial companies, has been doing quite well as well.
When we think about what's happening in the here and now, obviously you've been watching this space for quite some time. Are we seeing a pretty profound change in the way perhaps investors will start thinking about Europe going forward?
I think the political unity within Europe is new. The focus on growth, productivity, many measures we take for granted in North America, almost re-entering the European lexicon, is positive. I mean, once again, it will come down to earnings and actual delivery on these goals, but it does appear to be a step change in terms of a way of thinking of the continent in terms of focusing on growth, which is positive.